Ladies and gentlemen of the crypto space, we're live on a Friday, February 24th at 12:42 p.m. A little late, a little busy at the office. But as always, I get back to the community. I get back to the place where I'm able to talk about the things that interest me. This process allows me to understand or better understand what we do, and that obviously helps everyone else understand what they do. So this is a very organic, cumulative effect that we try and achieve. Synergy. As we all understand better, it betters all our potential to navigate the insanity of these markets. So as everyone that follows me knows, we're on social media, we're on Twitter, and we're discussing the shit show of macro conditions. This is a bit of a preface for the topic of conversation I would like to discuss today. I want to talk about protocols that are interesting. Now, this is very uncertain times, and I rarely ever talk about protocols because when you talk about protocols on social media, everyone's like, what's the protocol? Oh, he talked about a protocol. And I didn't even put the protocols in the title on YouTube that I want to talk about. That's how much distaste I have for most YouTube content that discusses protocols. I just don't like it. But obviously everyone that follows me knows we have an active portfolio. I have a, so I'm talking doom and gloom in some regards on Twitter, but I have a full portfolio, and it makes perfect sense considering the way I talk about the markets, the way I talk about capital management. So there's great rationale that goes into the way I engage with markets, the way I manage my capital. And it's not just, I'm going to buy this, it's going to go up in price. And so that's not the type of content I ever want to suggest uh, ever. So, hi guys. Topsy's in the house, Dan's in the house, Hilda, JW, Killis, Crypto Jake. Dan mentioned it's my birthday. Yes, it is. I'm 40 years old today, but I still got a little something left in me, I hope. Few protocols catching my interest. Let's do it. Um, Folks will throw around the originals, obviously. FXS, Frax, Lido, SGT. STG, Stargate, maybe that's what was mentioned, and Ethereum. So Ethereum is very interesting. Suffice it to say. Is that a reasonable statement? Ethereum is very interesting. Thanks, Crypto Jake. So Ethereum offers a risk-free rate of return denominated in Ethereum. Now, why do we say the risk-free rate of return? Because a currency producer issuing bonds, let's say the United States, the Treasury produces dollars, and they issue bonds to raise capital denominated in dollars that pay in dollars from Treasury tax receipts. So, or IRS tax receipts, whoever the hell issues tax receipts, what a bunch of bullshit. But it's a risk-free rate of return because the United States can print dollars as needed to make sure that they pay the interest on the debt. Risk-free, or at least that's pretty much what Yellen says when she's concerned about Treasury market liquidity and all the concern about the debt ceiling talk and default. You default on U.S. Treasuries and it's no longer risk-free, and it changes the entire game. So how do you attempt to cure the risk or these risks associated with risk-free? And the only way you're going to get above and beyond what the U.S. government has created is take people out of the equation. So this is why Ethereum is interesting to me. Clearly, there's risks associated with Ethereum that folks like Chris Black talks about so very well, especially the protocols. But from a default perspective of everything's going to work out as planned, Ethereum staking offers a risk-free rate of return denominated in Ethereum. You stake, you're getting your percentage of transaction fees, the MEV, so on and so forth. You're getting paid in Ethereum by locking Ethereum. It's a risk-free rate of return denominated in Ethereum. So what's going on in the crypto space right now is the LSDs, the liquid staking derivatives. And for lack of a better way to say it, it's a Cambrian explosion. We've seen plenty of Cambrian explosions. We've seen fork after fork of Uniswap, fork after fork of Solidly at this point. Aave got fork season, and LSDs are getting attention that is warranted. Um, it's a big deal, and it's not just it's not just Lido, it's not just Rocket Pool, and now it's a laundry list. And Frax really paved the way by pulling up strong in third and probably gonna overtake Rocket Pool. And now there's even derivatives, LSDs of LSDs. So this is very interesting because it's all based on the risk-free rate of return, Ethereum denominated. Now, we're not going to talk dollar denominated for the sake that we can actually have content about protocols. Now, you all have to take into account your risk profile and the shit show of macroeconomic conditions. And the odds are for most people taking positions in this environment, it's not necessarily the appropriate thing to do. Depends on a lot of factors. So risk-free rate of return means you could also leverage that risk-free rate of return. And this is exactly what happens in traditional finance. You get U.S. bonds, you leverage the crap out of them to get leveraged risk-free rate of return, but there's risk associated with just how your collateralization ratio, and if it breaches threshold, you get liquidated. So that's a complexity. And you can hedge that risk. And what is the biggest way to hedge risk in traditional finance is interest rate swaps. We're able to convert a fixed interest rate into a variable to be exposed to the variable nature of interest rates, or vice versa. You convert a floating interest rate into a fixed rate of return. So this is a mechanism to hedge especially leverage positions. Now, this market, as you could see here, is a $500 trillion market, and you don't have to take my word for it. You just go to the BIS stats on derivatives, and interest rate derivatives are $502.59 trillion. About 9.5 trillion credit derivatives, which is relatively marginal. Forex derivatives are 109.59. So Forex derivatives have been increasing since 2010, 2009 marginally. I find it interesting to watch interest rate derivatives and how they're disinflating. So they're lower than the peak, which was a double top in 2014 and 2012. And it has never recovered to the expansion, or at least the trajectory of expansion. So this really gives structural change, some optics into the structural change of the system. The system isn't expanding like it historically did. This plays into like what Jeff Snyder talks about, the disinflation of global currency units, the euro dollars, and stuff that Peter Zeihan talks about with demographics changing, the whole structure of people, which is demographics, which is the study of people. Everything's changing in that regard, which is changing the flow of currency around the world. The entire status quo of the system is based on the export of dollars, which is facilitated by negative trade balance. And for that information, you can refer to like Luke Groman's type of content. So the point is, a good part of the entire planet's current system is dependent on leveraged risk-free rate of return. And to hedge the risk associated with those leveraged positions, use interest rate swaps to the tune of $502.59 trillion. Now, I mentioned in this tweet a little earlier, IPOR. So IPOR is pretty much the only system, product, technological offering. It's heading down the road of that type of service. Now, I'm not too interested in the risk-free or interest rate swaps on stablecoins, on dollars, albeit I'm playing with it a bit. Oh, I can't access it obviously because I'm in the US, which is great. So I can't even show it to you because I can't be on stream and on VPN simultaneously. So I can't even show you the thing I was going to show you. So suffice it to say, suffice it to say, I'm much more interested in IPOR getting into Ethereum, um, and offering a capacity to hedge leveraged risk-free rate of Ethereum return. That's a big deal, especially as the system grows in the coming years. Um, I think that is that a period? A period. I mean, this is something that interests me. I guess that was the point. Some of the few protocols catching my interest. This is one of the protocols that is catching my interest because of what it offers conceptually, structurally, and almost everything we're doing in the DeFi space is an extension of traditional finance. And so many folks would argue, why rebuild traditional finance in this new system? Because traditional finance fucking works. There's so much distaste for traditional finance that folks are like, oh, let's not do it. Traditional finance works. The problem is the perversions. The problem is human subjectivity. The problem is excess debt, the growth beyond what was reasonable that got us to this perverted state. Now, when when that occurs, you're like, let's rebuild, and that's what's occurring. It's getting rebuilt, and we want to. And capital will find opportunity that is done with more care and more respect for the issues that were encountered in previous iterations. Now, first and foremost, that's why we talk about protocols that are deterministic by immutability. There's no human involved in the execution of the behavior of the flow of capital through the protocol. It's done by software, and that's meaningful because think of the Fed. If the Fed was deterministic and immutable, you don't need people. You just need software. And monetary policy, interest rates, the Fed funds rate would just be an algorithmic response to Oracle data that's fed into the algorithm. And that's what's occurring in the crypto space, and that's I find very fascinating to observe, because I think traditional finance works. I think Keynesian economics works. The solution to the shit show of a situation that Keynesian economics got us in currently is people. So if you take people out of the equation, I like what Keynesian economics talks about more so than Austrian economics. I'm not too fond of scarcity. I don't think organic financials is where the system needs to head. I think the system needs to head or continue to head in managed financial conditions, which is what they wanted to do with the Federal Reserve, but they didn't have the technology back then. And first and foremost, what I keep saying, will continue to say, is it's the people that are the problem. If there was no people at the Fed, there would be no one to point fingers at to to assign blame to when shit hits the fan. It's software, and the software needs to be coded for the best interest of two things: the people interacting with the software, as well as the integrity of the software itself. So stuff like Aave and how it best traverses crises and mitigates risk using the software implementation. That's wonderful. Those are the types of solutions traditional finance desperately needs. Deterministic solutions to crises. I don't have all the answers, but what I've seen is very interesting solutions that are heading in the direction that are providing real, meaningful, proposed solutions to historic crises. Get people out of the equation. Let software manage it. There's no one to poke fingers at, no scapegoating, and I find that very interesting. So IPOR catches my fancy because it mirrors basically the functionality of a $500 trillion industry. And I think LSDs, liquid staking derivatives, are just going to continue the Cambrian explosion, especially as Ethereum continues its deflationary drive. Minus 0.07% year over year since the merge. I look forward to Shanghai to see what happens with unlocks. I'm not a pessimist. In fact, I'm very much optimistic on almost everything. I think humanity will pull through almost any horrible situation. So I think even an unlock will just provide conditions that we have to assess. And you assess conditions to get a sense of potential path. This is what like Michael Guyad talks about. Um, I find my peace of mind understanding conditions today. I don't think too much about what's going to happen tomorrow or in the coming weeks, or at least I've trained myself to not fear them too much. I'm much more interested in understanding what the fuck's going on today, and I've structured my capital management, my portfolio, such that I own things that I'm likely to see exist, continue to exist in the future, because I've identified characteristics that support lendiness, or at least the potential observation, the likely observation of lendiness, and they're productive, which means that's what everyone talks about with regard to the wealthy in traditional finance. 90%, 10% of the people own all the assets. All right, so fucking start owning assets and own assets that are likely to exist in the future. And this is really an opportunity that's akin to the turn of the century and what like Buffett talks about when he bought Coca-Cola when it was like 5 cents. A company that has the potential to grow into something that's systemically relevant. Is that not what we're looking at? The potential creation of systemically relevant infrastructure? Because it really does improve on the bullshit problems that traditional finance is plagued with? So that's why we're here today. That's why we're here. I got one other protocol. Let me go through some comments. Let's take a look at IPOR though to give you a sense of. So here's the equation. The equation for protocols, when you see something new, there's two considerations. Let's go through the list of considerations. Systemic significance, check. Very systemically significant, especially as LSDs continue their Cambrian explosion. 2, risk profile. Who's building it, why they're building it. We know why they're building it. Who's building it? Should be a very interesting list from what I see. Risk profile of vested interest. Who owns supply? And this plays into like position sizing and getting an optimal entry if it's something that you want to own. So there's a lot of vested interest. The price is um, relatively inflated compared to its age, and the alignment of the people that own the protocol from a vested interest perspective is not really aligned, considering that the rapid appreciation we've seen and then the depreciation. The rapid appreciation is initial launch, it caught some attention of people, and then vested interest is selling. Bear in mind, this is what you always see. Every IPO throughout history in traditional finance, vested interest, employees are given options, insiders are able to buy before it hits public markets, they buy it on private markets, and then it goes to the public markets, capital floods in because retail does what retail does, and then vested interest sees a multiple 1, 2, 3, 400%, and vested interest probably bought on 50 cents to $1 speculatively. I don't know if the protocol has any vesting periods associated with tokens. They probably do. And frankly, this is a relatively muted depreciation associated with launch, or such a rapid appreciation from launch, because we've seen absolute catastrophes where there's ridiculous launch pads and it's like a complete collapse of price, and that's where there's absolutely no alignment. So this is indicative of a degree of alignment with vested interest, even though it's well over a 50% price collapse in the last 2 weeks, 3 weeks, 2+ weeks. So this is actually getting to interesting territory. I started to edge into a slight position, relatively small. I don't have much free cash left. But this is something that I would like to have a larger position in. What's interesting is when you provide liquidity to IPOR, it's akin to GPL from GMX. You're providing liquidity that's exposed to the P&L of the protocol. Basically, the liquidity of the protocol is underwriting the the interest rate swaps, the positions people are choosing, whether they want to swap a long-term interest rate for a short or vice versa. So the protocol generates revenue from that. And the power token design that they have is interesting. The folks on the team are highly qualified, and they've done their due diligence, and their Medium documentation and articles have expressed a great time spent on the history that we have, the short history that we have in the DeFi space of monetary policy and tokenomics. They've referenced Curve to a significant degree, and they mention the things that we talk about, alignment of interests, so on and so forth, and how to encourage, grow alignment of interest over time. Clearly, they have a product that has a tremendous history in traditional finance. That product has a fit in the entirety of the DeFi space, especially as LSDs continue to expand. I look forward to seeing Ethereum added to the list of supported implementations. And now the question in my mind is optimal entry price. So this, it could find support here. Support here is all dependent on vested interest. Now bear in mind, here's an interesting thing. You could see macroeconomic conditions completely degrade. Like, you could have a collapse of all financial markets. Why do people sell? People sell when they need cash. They sell when other people, when even if someone has a great deal of alignment, if other people are selling, a person that has alignment might be inclined to sell merely because other people are selling. So selling is contagious. You should always expect appreciation if you have extreme market volatility in the macroeconomic system, which carries through virally through all systems. So there's always the potential for cheaper prices, which is why it's imperative to always have cash. So how do we have cash? We have some savings, and we also have cash flow. So it's very important to never spend all your money, because there's always a potential opportunity to buy things at depreciated prices. So the price point here was enough for me to take off a small bit. I mean, relative to what I always tell everyone, 1% to 10% changes everything. I mean, I think this was like a 0.1% type of little chunk I bought, a fraction of a small, almost insignificant percent. I would like it to be bigger relative to where I think this will be in the next 5 to 10 years. I just don't have the capital for it, but you should take my choice in position sizing with a grain of salt, or as Luke says, a block of salt. You all have to make your own decisions in that regard. I'm just talking here relative to price, and the price is interesting. This was an interesting level. It found some horizontal action here for a couple of days, or a day. So here's the problem. There's nothing to go on. There's no time history to go on. This is all brand new. It'd be nice if this is cheaper. $1.75, get back to baseline. You'd be able to buy twice as much on the money. So that's where my mind is at with regard to looking at this price chart, the age of the protocol, the risk profile of the protocol, doing a little due diligence into who's building it. We know why they're building it. We know no one else is building interest rate swaps. Quite interesting, to say the least. And we know where the market is heading with the Cambrian explosion of LSD and derivatives, which is LSDs of LSDs. Holy shit, what, like urine is building? It's very interesting. Very interesting. Wavehead, thank you very much. I appreciate it. Your mother's birthday as well, February 24th. It's a good day. I've heard a couple of people with the same birthday. Dan, do you have an opinion on Redacted, Hidden Hand, Marketplace, and Butterfly? Well, Redacted is an ETF. That's it. Which is cool. ETFs are cool. I don't want to own an ETF. I could manage the ETF myself. So food for thought in that regard. Hidden Hand's a big deal. Butterfly is the same thing. Butterfly is another ETF, and that's meaningful. ETFs are cool. I got no qualm against an ETF. I just don't need them. But Hidden Hand's a big deal because Hidden Hand facilitates currency recycling. Period. It's as simple as that. So we've talked extensively about sovereigns, and countries that have created money, fiat money most recently, and they did anyone who issues bonds, and they did that way before fiat rolled around for the United States and the rest of the world in the 70s. Um, Bond is a form of currency recycling that takes currency out of circulating supply, creating future money by converting tax receipts to incentivize people to allow the government to perform a capital raise. Um, so currency recycling is historic. So what is hand in hand? It's literally uh, a manifestation and implementation of a novel currency recycling regime, which is quite fascinating. And there's many types of voter escrow. Each one of the currency recycler implementations that Hidden Hand supports has an entire story that you must do your due diligence on. Boom, boom, boom. They're all an entire story unto themselves. And every protocol has an entire story, but the currency recycler implementation of protocol to protocol is the most interesting story that I think exists in the entire crypto space because it has such a history with sovereign monetary systems and bond issuances. How does a country massage the amount of currency units in circulation? How do they create more? That's easy enough to create more. How do you distribute it? Clearly, we had a shit show in 2020 with the U.S. trying to distribute currency units. How do you remove them from circulation? All right, you issue bonds and you give future money, but then the traditional finance allowed you to collateralize those bonds and leverage the shit out of them. All right, so that's inevitable in the crypto space as well. So we'll have to see some risk measures and not just hedging, but it would be nice to see some limitations on the amount of leverage that the systems we expose ourselves to can create, or at least such that they're healthier. They encourage healthier behavior rather than the extreme perverted behavior that got us to traditional finance to where it is. Hope that helps. Loki, sup Noah? Hope your week was good. Oil down, up, DXY up, bond vol, spicy times, liquidity conditions. Thanks as always for your bloody legend, my man. I'm just here to help. I'm a little all over the place at times, but I can only hope to ever try and convey at least an informative story from a novel perspective. No one offers the perspective I do. Why? Because I'm me. So this is my story, and I think it's mostly coherent if you're you could piece it together well enough. It all makes sense in my mind. It all gets funny on the way out, though. So yeah, we're not going to talk macro though. I'll leave that to Twitter, and I'll post my rants about macro conditions. Hilda, hey. FXS now going 100% collateralization ratio changes actually the FXS tokenomics. So a lot of folks think that Frax is about fractional reserve. So Frax, um, it's a big deal. It was never about leverage, which is fractional reserve. It was always about the bootstrapping or the strapping on of monetary policy. So what's the reason for collateralizing something to mint Frax, the dollar stablecoin, is to be able to expose yourself to the monetary policy strategies or also the financial strategies of the Frax protocol. And Frax makes money. Frax attacks the protocols created to incentivize liquidity. So part of these systems, obviously Curve, Balancer, Frax is attacking them quite well, and they're growing their control over those respective ecosystems. So as Frax engages with those liquidity engines, which are forex markets, they generate revenue from the protocol's mechanic. And to top it all off, Frax has its own mechanic, its incentive system using FXS. And it's a very difficult story to tell because you're talking about really a market of markets. The second you talk about a protocol, you're literally talking about a market, which is very akin to talking about how the dollar works in the global financial system. You're talking about a currency. And to understand each one of these protocols, you have to literally look at them as if they're a currency. It's the only way to understand this shit. And you're looking at each currency's implementation of a recycler, how they're using incentives to encourage particular behavior. And what you realize, all of it is recursive. One behavior causes another behavior that causes the original behavior, and it creates a feedback loop. Now, obviously, people that are starting to digest this stuff will go to the concept of, they'll throw around libacious terminology like a Ponzi, but this is all about currency flow and recursive capital flow incentive systems. I'm telling you, the U.S. has a negative trade balance. They want to export dollars. That's what they've done for the last decades, where we've globalized and exported our entire manufacturing base to China. So now we have to export dollars. And where do you think those dollars go? They eventually come back to us. And that was the whole trade deal, or the deal with the Saudis. You're going to denominate your oil in dollars, but the Saudis are going to throw all their surplus dollars recycled back into U.S. government bonds. So it's all that recursive loop. If we're exporting dollars, it's going to come back to us. Why? Because people are going to buy shit from us using dollars. And it just so happens the entire world started denominating everything in dollars, so that just made it all that much more complicated. But it's all the same. Traditional finance and these systems, except these systems are new, they're innovative, and they're doing things in the same way with different mechanics, different incentive systems. So they, and obviously memes and all this branding and the new spin. It's a new age. It's a new technology. So as much as it's easy to get caught up in the hype of how new things are and the price action of how everything goes ballistic at times, when you peer through the bullshit and all the hyperbole and exaggeration and all the hype, it really is a story to be told looking at these protocols as traditional finance tried to originally do them. And that's what I find most fascinating. That's the story I like to tell. Looking at crypto through the lens of traditional finance. Anyway, so Frax catches my fancy. That's a historic position. I've had that. Yeah, watch. So I bought Frax very shortly after IPO. IPO. No, this is not a good chart. That's denominated in Frax. We have to find it on, maybe the history is on Uniswap. We need V2. Yeah, it's V2. So obviously we had our big run. I was probably here. This is initial look, initial launch, vested interest, all that conversation we just had about IPOR, and here's all the chop. I think I was in around $4, give or take. Probably around there. 21, August of 21. That sounds about right. So I saw this go all the way to $40, but you guys know me. I lock as VEFXS. So I watch it go to $40. I'm sitting through all this shit, and now it's back to $10. So what? In 2 years' time? All right, I got 100% of the money. I can't sell it. I can't liquidate it. It's in a liquid position. So how do I compartmentalize the fact that I could never sell it if I wanted to? All right, we're not going to digress into how I manage capital. Suffice it to say, I'm very fond of this position. Hope that helps, Hilda. I think they're heading in the right direction with the collateralization ratio change, and I think they have more than enough of a product and a coordination and a synergy with what they're building with the other protocols and the ownership of other protocols' governance rights. And those governance rights influence respective monetary policies such that They have a lot of power. Power in a burgeoning, emerging market financial system. How about that? Loki, thanks, Noah, so much. Seriously awesome service you do for us. It's a pleasure. One Curious View. Osarko, happy birthday. Dabble in some speculative bets for some birthday fun. I have. I'm trying to make rational decisions in a very irrational market. So the IPOR was microscopic. I threw some liquidity in. I like the notion that it's basically a GLP position on Ethereum mainnet. PNL on interest rate swaps. I wish I could pull up the site. I don't have VPN on, so I'd show you how much notional. I think they got like $1.4 billion worth of notional outstanding. So that's pretty cool, which is probably like 20, 30 million bucks worth of collateral that's been posted for very leveraged interest rate swap positions, where people are hedging or betting on the directionality of the interest rate. And the interest rate is, I believe, on stablecoins at this point, and that's probably provided by an oracle that's taking an aggregate of stablecoin demand. So this leads me into the last thought about IPOR, which is why I'm much more excited about Ethereum rather than stablecoins. Ethereum is native. It has an interest rate, and within the crypto space, within the Ethereum network, the interest on Ethereum is a risk-free rate of return denominated in Ethereum. So I think they probably started with USDC, stablecoins, maybe just for initial launch, and I think obviously the future is for them to dabble with Ethereum and the LSDs, and that's the future. Chainlink oracles may be part of the next move up. Well, Chainlink's always part of a lot. In regards, I like what Chris Black talks about with regard to Chainlink. I'm not as fond of Chainlink as many that are very bullish on them. They provide an invaluable service for taking data outside of the network and bringing it on chain, allowing contracts to execute based on that data. That's invaluable. And obviously, Chainlink is going to facilitate cross-chain, and there's the whole conversation of Chainlink CCIP versus Layer 0. I don't think Ren is completely written off. It may take a couple of years to catch up and build some momentum. I think their 2.0 implementation, I look forward to seeing the software, because the software didn't just evaporate into nothing. It needs deployment, and there's structure and processes in place that would need time to develop, and it'll get deployed. But Chainlink and Layer 0 probably are in the strongest positions with regard to cross-chain capital flow. My general sentiment regarding cross-chain capital flow reduces primarily to liquidity. I'm not too interested in the L2s. They have microscopic liquidity. I did a Twitter post probably 2 weeks ago at this point, and it's like Ethereum is 50 times as large as Arbitrum, or whatever the multiple is on Optimism. It's like 100 times as large as Optimism, 112, 120 times as large as Optimism. So $79 billion on Ethereum mainnet with finally a positive sum game, a marginally positive sum game on the 7-day period on Ethereum mainnet. Bear in mind, with $79 billion worth of liquidity, a 0.48% change is meaningful as compared to looking at an Arbitrum with a 13% change in liquidity on $1.37 billion. So, but this is interesting. That is a big spike in liquidity conditions. $1.49 billion. So in one day, Ethereum received more liquidity inflows than the entire size of all of Arbitrum. That's a perspective that must be considered. So for this reason, I focus primarily on Ethereum mainnet. That's where the liquidity is. In one day, the entire capital size, capitalization, all liquidity in Arbitrum flowed into Ethereum. Just, you know, sporadically, just, was yesterday? A Thursday. No, it was a Wednesday. Oh, just a casual Wednesday. Arbitrum decided to flow into Ethereum mainnet. Ain't that some shit? Aave's been thinking about them a lot lately. Aave's a big deal. And it's a big conversation to be had about where protocols are going to head with regard to government organization, KYC, rules and regulation, alignment with regulators versus the original point of DeFi, which is you don't need regulation for deterministic, immutable contracts. You don't need reporting. That's all Dune Analytics. You throw up a Dune Analytics dashboard, and literally that's reporting. And there's no people to do the reporting. It's a damn website that pulls the data from on-chain. So, a lot of opportunity comes in the form of traditional enterprise, where you have developers that are building out a protocol, and it's an investment. So obviously, those types of protocols fit firmly within the lens of what the SEC would label a security, because you're investing in the protocol and developers are still working on it, so your investment is based on their work. So, while I'm not fond of the regulatory hammer of security registration and all that shit, I'm more fond of due diligence and personal responsibility. That just is an observation and a consideration. And that's exactly why one of my biggest talking points is immutability and determinism. Then there is no regulation. You can't regulate software. You can regulate people. And software that's deployed that has no capacity to be regulated, that's powerful, which is my primary perspective when managing my capital. I want to own things that are not dependent on people. They're dependent on literally the network continuing to exist. And if the network continues to exist, the contracts that are immutable will continue to exist and operate, providing functionality and service. They will grow over time. Those are the most meaningful systems in all of the crypto space over the next 5 to 10 years. The ones that do not require further development. But further development is managed by DAOs. And the DAOs, there's a whole argument of whether DAOs shield from securities regulation. And the SEC has been fighting and tried to push through some DAOs and hold some people responsible and all that bullshit. What an absolute ridiculous situation. People in government are causing. People are such a problem. Subjectivity, opinion. I have my equities and I think they're good investments, but I'm so sick and tired of people. I find such peace and relieves my anxiety thinking of software that can't be changed. Just executing on repeat. It just does what it does, and it's going to behave exactly how it has behaved, because that is what software does. If you can't change the code, its behavior is predictable. And I find such peace in that thought. So that's why I like this space so much. HB, finally catching live, best 30 minutes of the day. It is for me as well. A lot of people in the stream today. 47 people, 13 likes. Thank you all. I still have yet to bring up the other protocol I wanted to talk about. Killis, what is the big hype role of Coinbase's Ethereum L2? Basically, TradFi, liquidity, capital, and potential KYC. If Coinbase offers, a permissionally accessible system, but protocols could opt in with KYC, that has the potential to allow significant capital inflow to the tune of many more multiples than have flowed in to date. Trillions, 10 trillion, big numbers. If it's KYC and regulated and they could report their SEC required reports and all that shit, That changes the equation. So it's interesting. I don't see any consideration from a capital management standpoint. I just find it interesting that this is what they want to do. And if it has legs, it has legs. Conditions. The conditions of today bring me comfort, understanding what's going on today. What may play out is interesting. Let's see what happens with Coinbase and what they're working on. Base looks like a load of crap. Genie Kid, it's going to be what it's going to be. I don't speculate too much on what it's going to be. Wave, IPOR Tokenomics seems not all that great, but I like IPOR and hold IPOR for the long term. Well, long term alignment, look, you're aligned vested interest, you own it. So, all right, we'll see what happens. This is why it's imperative to deploy restraint and think rationally with rational position sizes, digesting the vested interest, and getting a good price. If it's not a good price, if it's not on discount, it's probably not the best time to take a position. Heath, curve fee sheet you referred to on Monday, 2021 at 58 mil, 2022 at 45 mil. Would you consider these as curve earnings? Oh, the fee sheet would be interesting to see what these fees will be next cycle. Yeah, if you go to curve, I don't remember if this is what I showed you, but this is their fees. This is the fees the protocol has generated on a weekly basis since launch. September 16th, 2020 was the first payment. Has been $112 million worth of cumulative fees that the protocol has earned. And since the admin fee and the DAO voted to distribute a portion of the admin fee to DAO owners, a good portion of this has been distributed to people in the form of a dividend. Call it what you want. Dividend's a dividend. So it would be very interesting to see in the next cycles. Don't sell it short. Think 5, 10, 15, 20 years out. What happens when it's $10 million a week, $100 million a week? It's time. Time is the equation, and the only other consideration is if you got a good price. Did you buy it cheap enough? Can you potentially get it cheaper? And that's the calculation. It's up only if you're thinking of a 10, 15, 20-year time horizon and the protocol continues to exist, which is why we talk about deterministic and immutable. The software, if the network continues to exist, the software exists. So anything that's deterministic and immutable is very likely to continue to exist as long as Ethereum continues to exist. And it reduces that part of the risk assessment process. Adam, IPOR looks really interesting. Is GitHub the best way to dig into the team? LinkedIn. The names of the people are on the website, so LinkedIn's a great way to do some due diligence in who's building it. As for vested interest capital-wise, that requires a little bit more digging maybe. Was there an initial sale, an ICO, and stuff like that, as well as launch incentives. Clearly, there's always a run-up with liquidity mining, and then it drops off, and complicated equation. But as Wave said, tokenomics seem not all that great. So, do your due diligence, look into the tokenomics. What catches my fancy is literally they mention Curve. And if you're mentioning Curve, you understand to a degree voter escrow, you understand currency recycling, you understand incentive systems, and it's not just Curve they reference. So it does catch my fancy that they've done their due diligence. And from what I could tell, they're quite qualified. At least that's what the names and the faces of who's building it express when looking into who they are. So, it's interesting. Hilda, Frax still owns their liquidity. It's just the minting mechanism is now gone. But the new narratives came to, it's like an LSD and Fraxland that expand options. So that's right. They have this entire stack. They have lending with Fraxland. They have the Frax Ferry. So they have cross-chain. So they facilitate seamless liquidity transfer across chains. They have the whole stack. It's a whole infrastructure. It's way more than just a fractional reserve currency. But even when they were a fractional reserve currency, they dominated POL, protocol and liquidity. So as long as they own more LP than Frax in circulation, 100% of Frax in circulation could be sold, and they have a capacity to maintain the peg. That's crazy. That was always crazy, and that proved to be the case when when the Luna collapsed. That was a hell of a stress test. So clearly, by them going 100% collateralized, they're trying to change the narrative and how people think about their core offering. Interesting. You're welcome, Hilda. Kill us, happy birthday. Thank you very, very much. Paul, you as well. Thank you. Mario, FXS lock for 4 years at $2. Very nice. That's a good entry, in my opinion. I think that's a good entry any way you look at it, especially technically. Happy birthday. Thank you. Make a wish. Thank you all for the birthday wishes. Lols, curious on your opinion that new stablecoins coming up from protocols like Curve. Yeah. Um, Aave versus Curve. This is another one. This seems like the ultimate regulated stablecoin backed by treasuries. Ondo Finance with OUSG. Well, I believe their stable is OUSD. Look over their docs.ondo.finance, backed by treasuries and other shit like HYG. I don't know who would back stablecoins with high yield debt, maximum risk bullshit. So this is interesting. It's not interesting. Um, but my sentiment does fall on CRV USD as the most interesting. Um, Aave is a big deal. Uh, the question in my mind always reduces to lendiness. What is likely to exist in 5, 10, 15, 20 years? And Aave is likely to exist. How immutable are they compared to what Curve has built? What is the systemic significance of Curve versus Aave? These are great questions, and there's no specific answers. All it is a mental exercise trying to assess what potential return by finding an optimal position, which is an optimal price point given current financial conditions. I don't know. Aave hasn't played out very well um, financially. Let's take a look. I mean, Aave doesn't have a currency recycler. They have issuance. So it's not the same consideration from structural significance. So obviously they provide a money market. That's a heck of a service. It's very meaningful systemic infrastructure. But Curve offers a forex market that has a novel currency built on top of it to incentivize human behavior. So Curve was the first protocol, pretty much all of crypto, to take cues from traditional finance, sovereign financial constructs. Uh, I mean, that's pretty obvious. I mean, obviously, like incentive systems started with synthetics. That was the first contract. And SUSD is meaningful from a historical lens. But Curve hits a lot of different other marks that other protocols don't, even the historic synthetics. And then obviously all VE throughout all of crypto is ultimately a derivative of what Curve came up with first. Happy birthday. Thank you, Johannes. I appreciate it. One other protocol, and we'll wrap it up for today, which was LIT, which is timeless finance. Let's, here it is. So these are interesting products that they've created. So timeless, aside from their bunny product, is basically derivatives of yield-bearing products, and even LP positions. and their NYT and their XPYT. So there's short and long as well. So I like these products. I personally don't have use for these types of products. I'm much more interested in overall monetary policy of currency producers. It's metaphorical, but really is what they do. So these are more of LP type of positions that encapsulate and modularize, componentize yield-bearing positions based on prevailing forex markets and money markets. I don't see why they can't expand this. So these products are interesting. Their bunny product is probably what catches my fancy much more than this. But I do see systemic significance to those products that they started with. This is their second type of product, which is using the LIT token as well. And this is the bootstrapping of voter escrow on top of Uniswap v3. So my sentiment is Curve has a dominance with regard to being a currency issuer. Urban Aura and Balancer have shown that there's room in the space for competition. And it seems to be that volatile assets have found it more favorable to opt for, especially those 80-20 pools that Balancer has innovatively come up with. It's gained a lot of attention or is quite profitable from a weekly revenue, bi-weekly revenue standpoint, and frankly, Balancer I think is going to catch up. That was a position I took a couple of days ago, folks, on Discord. I mentioned to you guys, and I did up the Balancer position when I mentioned I did. I think returns on Balancer are going to do well in the coming years. So let's take a look real quick for the fun of it at what Balancer is offering. I mean, this number's been going up. There's a lot of weekly capital that is being deployed to affect various monetary policies. And Balancer has some new incentives flowing around. 82% on vote market, 51% hidden hand last week. This is brand new. Only 12,000 VE BAL votes. It's clearly going to get my vote, but I can't vote till next week. 40%, 30%. These are big numbers. If you look at Curve, these are relatively marginal. They're small, but what these do nicely is draw votes away from the larger positions. This one catches my fancy. Lido is the final voting period. So this is a large market, and I think vote market was very aptly named. So it was well done by Stake DAO. Could always look at Warden as well. So why am I showing this to you guys? Because this is basically the manifestation of two protocols right now that have a fair amount of capital deployed to affect monetary policy as capitally efficient as possible. Curve and Balancer account for all of this, all the bribes, which is the rental of votes. Now, this was over $1 million when before like Friday, earlier this week, before this week's recent payments. So, but this is huge already. $547,000 on a weekly basis is $2 million a month in potential payments that people could purchase. You literally could purchase a portion of those weekly payments, or bi-weekly in the instance of Aura. To see Aura's capital flow potential, you look to the Llama Air Force, and you see on their rounds page, you go look through the history, and this is where you get a nice breakdown of what you could potentially capture. So the dollars per VL Aura has been going up very nicely. Clearly, it got hammered pretty hard, down to 3 cents, give or take. I think we saw upper twos, but this past week was 6.3 cents. That's very nice to see. Let me organize my tabs. And then obviously a good portion of that is facilitated by hidden hand. This is Aura and Balancer, where a fair amount of capital is deployed for the renting of votes in a capital efficient fashion. This is where Bunny will have its capital deployed to. Um, Other capital is also deployed directly to Vote Market, and you'll see that breakdown here on the left. Vote Market, Vote Market, what is this, Balancer? No, it's Curve. So the vast majority of vote rentals are done through Vote Market, but obviously here's the Warden, here's Abracadabra, which has never changed from Y-Bribe, which is cool. I think they're the only one who uses Y-Bribe. I think this is probably an automated process that Curve just lets. No, that was final voting period. So it looks like bribe.curve.finance, that original implementation, has finally been deprecated. But let's talk about the final protocol, which is Bunny. So sentiment is Curve owns stablecoins. That's where all the momentum is. Aura Balancer has taken a fair amount of volatile assets and has been greatly successful. Curve V2, it's still there, and it's not going away. The attention right now is on Aura and Balancer. Those are the leaders of the pack with regard to capital efficient liquidity incentives and the renting of monetary policy and that whole story. There is none of that for Uniswap. It doesn't exist. This is an implementation that attaches the system that Curve and Balancer created, which Convex and Aura bootstrapped to faster success. This applies it to Uniswap. So I find it very interesting. Where it heads financially, obviously that's up for risk evaluation to consider. It's been quite volatile, relatively new. Let's go out to the daily chart and give some perspective on how new it is. You're talking about a couple of weeks, January, of live liquidity activity. It's expensive. It's actually quite expensive for the age. $10.8 million market cap, 50 mil fully diluted value. This is not a discount. I said this in a tweet a little bit earlier. There's very little opportunities in the market that are at a discount. Everything's still at a premium. This is at a premium. 4 cents. It's the low, but look, you have no idea what a discount is because we don't even have like a macroeconomic event to really show us what a damn true discount is. So you can't look at this space myopically. You have to look at it as an emerging market within a global financial system. There could be a great deal of opportunity for discounts, which means don't spend all your damn cash. I didn't want to talk about macro, and I managed to get through this entire stream without talking about macro. So I like this protocol. I snagged some upper 70s, 77, right about here. When I saw it breaking above this previous high, I took a position. Does it depreciate? Great. Does it appreciate? Great. When you vote or escrow and you lock your position, it's not a position. It's a purchase. If it goes down, could I have owned more of a position? Sure. So the disappointment is that I didn't have a chance to own more. Do I have free cash because of revenue from other sources? Yes, so I could buy some if there's a discount available. Was I interested enough in what this protocol is offering from a systemic, infrastructure potential? Yes, I took off a position. Does it offer revenue? Not really. We'll see what kind of revenue comes in. I have seen indication that Frax as well as Liquidity are probably wanting to use this system because currently Liquidity uses Aura and Balancer. They tried to play around with with the Curve system vis-a-vis, I believe it was Warden. They threw around some incentives, but they shifted over. Um, but Uniswap is another story. So here, Uniswap, folks are like, Uniswap doesn't have legs. One, Uniswap isn't going anywhere. Um, it's just not. So you have 1inch that aggregates across all the exchanges. That's great. It's going to give you your best price. Curve's going to give you great prices on stables. Solidly's coming into the picture, and they get all their activity from 1inch because no one's going directly to Solidly. Maybe a marginal part of market actors. I mean, no one's really going to Curve. You use aggregators, but there's a thing about Uniswap that is real. People go to Uniswap and they just use Uniswap, especially novice market participants. So Uniswap has that kind of momentum. It's not going anywhere. It is almost always a loss to provide liquidity, but that's not the same equation for protocols. For Frax, it's not the same equation for stablecoins either. So Frax has a lot of liquidity on Uniswap. Liquidity has a lot of liquidity on Uniswap. So there's a great reason to think that those protocols are going to want to deploy capital to incentivize the strengthening of liquidity on Uniswap. Sure, they could incentivize liquidity on Curve using the Curve mechanic as well as the convex mechanic, or incentivize liquidity on Balancer using Balancer and Aura. But how do you do it on Uniswap? This is the only system thus far to facilitate that kind of behavior on Uniswap. So that catches my fancy in that regard. Uniswap isn't going anywhere, even if there's plenty of better. And obviously, obviously Balancer is much more interesting than Uniswap. It's much more structural and creative with regard to multiple assets in an LP position, as well as the 80-20 positions, and that's very innovative and quite interesting. It always was since inception. And Curve obviously dominates stablecoins, and the narrative for CRV USD is downright exciting. But that does not diminish the path for Uniswap, as it's just going to continue to exist because it does exist and it's strong, and over the years it will just get stronger. How the balance of strength of these protocols evolves into the future, you will always question that. And we will assess conditions as time passes, how Uniswap compares to Curve, compares to Balancer, compares to, let's see if Solidly catches some legs over the years. And notice how I'm talking about primarily mainnet. I'm not really talking about the L2s, and we'll continue with that into the future. Primarily mainnet is my interest. Any further questions? We'll wrap it up. I like how Y2K adapted the 820 base pool for vote locked. What's a Y2K? But yeah. What you'll see is iteration. You'll see protocols that take the best of what has been created to make something that's better, which is something that caught my fancy with stuff like Tapioca, which hasn't launched yet. Now, bear in mind, one of the most interesting things about Bunny is, where is it? Let me move these tabs. I'm moving tabs. Give me a second. Where's the Bunny tab? Is it here? Hello, Bunny. So Bunny took a cue from two protocols, primarily Fix4x. So Fix4x was the first to ever offer incentives, emissions in options. So every incentive that's provided to liquidity is an option, which means to capitalize on any of the incentives, those options need to be exercised and purchased. So if you have 100 grand worth of options that you receive from liquidity as an incentive, you need to purchase them for 50% Ethereum denominated. So this protocol is, in theory, a revenue generating machine for the protocol. Because if someone's going to want to exercise the option, they just got free incentives. They got paid to provide liquidity, so they're going to exercise to capture what profits, and as an actor capitalizes, so does the protocol. So this protocol should continue to have a fair amount of income, and how that income is directed towards further development, which is an ongoing discussion in the timeless community. Salaries for developers, which I agree with entirely, and how some of that revenue is also allocated towards incentives. Literally, they can also, like for instance, a lit USDC or a lit ETH LP position, and they could literally just rent bunny votes for their own liquidity, and they have the capital to do it because they're making money as they sell lit, as actors exercise their OLIT options. So the only other protocol to do this originally was fixed forex. And the only other protocol that has ever talked about this is Tapioca. So this is a very interesting mechanism. When you're thinking about a protocol, you must assess it from a value perspective, which is inspection of the balance sheet. Income versus capex. And obviously monetary policy creates an entire other layer of complexity that I would argue makes it not the traditional evaluation of like an equity, when you're looking at literally just the balance of payments, income versus capex, and whether their bottom line is in the red or in the green. Monetary policy adds another layer of color to the inspecting the health of these protocols, more akin to a sovereign nation than a traditional enterprise. Now, bear in mind, you still have no debt on the balance sheet, which is quite interesting for any protocol. And some protocols want human resource expense on the balance sheet. This protocol wants human resources expenses on the balance sheet. Great. It all gets thrown on the balance sheet. So bear in mind, I still favor a protocol that doesn't have human resource expenses, and it's just software. Whew. So today was a hot one. We talked about protocols. All right, that's the deal. I didn't talk macro today, but I'll get to that on Twitter. Thank you all for joining me. 47 people in the stream, 18 likes. We could do better. Smack those thumbs up buttons. Tell everyone to subscribe. So if you don't listen, I can't help people to do a little bit better. Friday, February 24th at 1:36 p.m. Thank you all for joining me. You know the deal. After party on Discord for the most rational community in the entire crypto space. I wish you all a wonderful weekend. I will see you all again on Monday. Peace.